So NIO has actually just posted its first ever quarterly net profit. And I mean, it triggered an absolute 80% rally over the last year.
Yeah, it's been wild to watch.
Right. It's flashing strong buy signals across the board right now. But, here is the massive catch.
There's always a catch.
Always. Strict discounted cash flow models are saying the stock is actually like 36% overvalued.
Wow.
Yeah. So is this EV darling truly an undervalued comeback story? Or, are we looking at the ultimate value trap for retail traders?
That is the big question.
It is. And that is exactly what we're going to figure out today. But first, do us a favor right now. Hit subscribe, like this video, and it is absolutely compulsory that you leave your feedback in the comments below.
Yes, definitely let us know.
We want to know exactly where you stand on this stock.
Ow.
And finally, I have to make it explicitly clear right up front, this deep dive into NIO's financials, the technical signals, the Wall Street debate, it's strictly for educational and conversational purposes only.
Right. No financial advice here.
Exactly. We are not giving you financial advice today. We are just unpacking the facts.
And, in the electric vehicle sector, unpacking the facts requires a very objective lens because this is a notoriously volatile space.
Oh, absolutely.
Fortunes here are made and lost on like the slightest shift in delivery numbers or macroeconomic headwind.
For sure.
So our mission today isn't to tell you what to do with your portfolio. It is to equip you with the raw data, explain the mechanics of what is actually driving this price action, and, provide the context so you can make up your own mind about where NIO is heading.
Okay, let's unpack this financial earthquake, because to really understand the massive momentum we're seeing on the chart, we really have to start with the catalyst.
Right, the earnings.
Yeah, NIO's landmark fiscal year 2025 earnings report. I mean, the top line numbers are staggering.
They really are.
Total revenue hit $12.1 billion, which translates to about 87.49 billion renminbi.
The Chinese currency, right?
Yeah, and that's important context since their primary operations are domestic. That revenue figure is a 33.1% year-over-year increase.
That's massive growth.
Huge. And the total net loss narrowed by 33.3% to $2.14 billion. But the absolute showstopper, the thing that ignited this rally, was Q4 2025.
Right. The profit.
Exactly. They achieved a net profit of $40.4 million, or 282.7 million RMB.
I wouldn't just call it a showstopper. I mean, it is a fundamental paradigm shift for the company.
A paradigm shift.
Yeah, because reversing that massive prior year loss is huge, but you have to look at the mechanism of, how they actually did it.
Okay, walk me through it.
Well, it wasn't just selling more cars. Their gross margin expanded to 13.6% for the full year, and it hit a highly impressive 17.5% in the fourth quarter.
Wait, 17.5%?
Yeah, and if you're watching this space, gross margin is literally everything in the EV game. It tells you whether a company has finally reached economies of scale.
Because building cars is so capital intensive, right?
Exactly. When you first build a car factory, your fixed costs are astronomical. You basically lose money on every vehicle.
All right.
So hitting 17.5% in Q4 proves that NIO's manufacturing processes are finally, scaling efficiently enough that the cars rolling off the line are generating real cash.
Which is what everyone has been waiting for.
Exactly. I mean, They actually generated positive operating cash flow in both Q3 and Q4.
But wait, hold on. Because if you are holding this stock or thinking about buying it, there's a flip side to this balance sheet that looks a lot more dangerous.
Okay, lay it out.
Yes. Their total cash position is solid at $6.6 billion as of the end of 2025. But their current liabilities still exceed their current assets.
Yeah, that's true.
And the real kicker, their debt-to-equity ratio remains staggeringly high at 456.97%.
It's a big number.
It's huge. I mean, this sounds like someone who just got a massive raise at work and finally had one single month where they spent less than they earned.
But they still have the credit card debt.
Exactly. A mountain of credit card debt hanging over their head. So is one profitable quarter really enough for the market to celebrate when the debt-to-equity ratio is over 450%?
Actually, what's fascinating here is that credit card analogy kind of misses a crucial piece of the EV puzzle.
How so?
Well, I think focusing entirely on that 456% debt figure as a pure negative is It's a mistake. Yes, it's a massive legacy burden, but you have to look at why that debt exists in the first place.
Okay.
NIO doesn't just build cars, they build battery as a service infrastructure.
Yeah.
They have spent billions constructing thousands of battery swapping stations across China and Europe.
Oh, right, the battery swap stations.
Yeah, and that requires heavy machinery, real estate, massive capital expenditures up front. That is what built their competitive moat, and that is what that debt actually represents.
Wait, so you're saying the market is just like forgiving the debt because it bought them an infrastructure advantage?
Pretty much. The stock market is a forward-looking mechanism. It doesn't price a stock based entirely on what the company spent yesterday to build its foundation.
Right.
It prices the stock based on the trajectory of its cash flow tomorrow. And what NIO demonstrated in Q3 and Q4 is a definitive pivot toward profitability.
Which is what investors want to see.
Exactly. They proved that despite the heavy debt servicing, the actual business model, selling cars and swapping batteries, can generate more cash than it consumes on an operating basis.
Okay, that makes sense.
Markets reward that specific inflection point disproportionately because it signals the company might not need to, dilute shareholders with new stock offerings just to keep the lights on.
Dilution, the ultimate fear.
Right. But, to validate your concern, if any macroeconomic shock disrupts their sales volume, that massive debt load goes from being a strategic investment to an existential threat very quickly.
Yeah, it's a double-edged sword. And because the market is pricing in this new, profitable trajectory, the stock chart is just lighting up with intense momentum right now.
It really is.
Let's talk about how traders are actually voting with their wallets. As of our focus date here, April 17th, 2026, the price is sitting at $6.87.
Okay.
It was up 6.84% just in the latest trading session, giving them a market cap of $16.81 billion.
Solid.
And when you zoom out, the trend is wild. I mean, shares are up roughly 37% over the last quarter and about 80% over the past year.
Yeah, a huge rebound.
Rebounding from a 52-week low of $3.24 all the way up toward a high of $8.02.
The technical indicators are practically screaming bullish trend reversal right now.
Yeah.
But instead of throwing a dozen numbers at you, let's look at the mechanisms that actually matter.
Okay, what should we look at?
Let's talk about the simple moving averages. The 50-day moving average is sitting at $5.50, and the 200-day is at $5.59.
Got it.
The current price of $6.87 has broken cleanly above both of those long-term trend lines.
So explain to the listener why breaking those specific lines matters so much.
Well, a 200-day moving average is essentially the stock market's long-term memory. When a stock is trading below it, the default psychology is pessimism. Sellers are in control.
Right.
When a stock breaks above it, especially with heavy volume, it signals a fundamental shift in market psychology.
The bears give up.
Exactly. The sellers who dominated NIO's multi-year downtrend have been exhausted, and buyers have clearly taken the wheel. Furthermore,
the moving average convergence divergence.
Yes, which measures the relationship between two moving averages to gauge momentum, it's sitting at a positive 0.48. That indicates a bullish crossover.
Okay, and mechanically, what does that mean?
Mechanically, it means the short-term buying pressure is accelerating much faster than the long-term trend.
Okay, but there is a massive red flashing light on the dashboard here that we cannot ignore.
The RSI.
Yes, the 14-day RSI, the relative strength index, is sitting at 71.06. That puts it squarely in overbought territory.
It does.
I mean, the RSI is essentially a speed limit camera, right? When a stock shoots up too fast without any down days, the camera flashes red. That's our 71 reading.
Right.
It doesn't mean the car immediately crashes, but it means momentum traders are going to start taking their foot off the gas to, lock in profits.
Yep, completely normal.
So if we are rushing toward that immediate resistance level of $7.42 and eventually that 52-week high of $8.02, aren't we just begging for a harsh pullback?
It's definitely a risk.
I mean, strong support is way down at $6.30 and $5.80 near that 20-day SMA.
Yeah, and that is the exact tension anyone trading this stock is wrestling with today. You have an undeniable structural trend reversal shown by the moving averages.
Right.
But you also have short-term exhaustion shown by that RSI speed camera. When an RSI breaks above 70, the current buying velocity is mathematically unsustainable without a breather.
Exactly.
So for you, the listener watching this stock, That tension means you should prepare for heavy volatility rather than like a straight uninterrupted line up to $8.
It's never a straight line.
Never. The smart money is watching to see exactly how the stock behaves when it hits that $7.42 resistance.
And if it gets rejected?
If buyers balk and it gets rejected hard, we could easily see the price retreat to test that $6.30 support level just to cool off the indicators.
Makes sense. And, you know, that tension between breathless momentum and looming resistance is exactly why Wall Street analysts and retail traders are so fiercely divided right now on NIO's true value.
Oh, absolutely divided.
When you look at the analyst ratings, the consensus is technically a buy. We've got 45% saying strong buy, 9% buy, 27% hold, and 18% saying sell or strong sell.
Pretty widespread.
Yeah, the average price target is $6.80, which is basically right where the stock is currently trading, though some of the more aggressive high targets reach up to $8. But the real story here is in who was actually doing the buying and the selling.
Right. This is where we have to look under the hood. If you look at the insider activity, there haven't been any major sales in the last 6 months.
That's a good sign.
It is. Key figures like the CEO William Li and President Li Hongqin are maintaining their significant holdings. That projects confidence from the very top.
Right.
However, institutional ownership tells a completely different story. The number of institutional shares held changed by negative 14.52%.
Ouch.
Yeah, that means big funds, banks, and institutional players were actively trimming their positions during the multi-year downtrend.
Right. And what's filling that void? Retail traders. If you are a retail investor listening to this, pay close attention.
Yep.
The sentiment right now is highly positive among retail communities, and it's being driven by pure momentum and the hype around this recent profitability milestone.
Sure.
But here's where it gets really interesting. If we look at strict discounted cash flow models, the DCF, they put the intrinsic value of the stock between $4.75 and $4.77.
Right. The math doesn't look great.
No.
Yeah.
That implies the stock, which is trading near $6.87, might be roughly 36% overvalued based on its historical cash flows.
Exactly.
So we have retail traders buying into the hype of delivery growth, while institutions were quietly trimming their positions. If the strict math says the stock is only worth $4.77, aren't retail traders just acting as exit liquidity for the big institutional players?
Well,
Are we looking at a classic value trap?
I think exit liquidity is a slightly cynical view, but this raises an important question about how we actually define value and how these models work.
Okay, let's hear it.
Let's explain the mechanism. A discounted cash flow model, or DCF, tries to predict every dollar the company will ever generate in the future and discounts it back to what that money is worth today.
Right, standard valuation metric.
Right. Now, a classic value trap is usually a stock that looks incredibly cheap by traditional metrics like having a low price-to-earnings ratio, but the underlying business is fundamentally broken or in terminal decline.
Like a dying retail store.
Exactly. People buy it thinking it's a bargain, the business continues to shrink, and they get trapped holding a dying asset.
But that's not what is happening with NIO.
Exactly. With NIO, we have the inverse scenario. The fundamental business isn't in terminal decline. In fact, the bulls will eagerly point to the record delivery growth of 136% year over year we saw in March 2026.
Massive growth.
The debate here is about a growth premium, not a traditional value trap. Because a DCF model relies heavily on historical data, it is notoriously bad at pricing in sudden, explosive growth or a radical pivot to profitability.
Ah, okay. So a growth premium means people are willing to overpay the mathematical model today because they think the company will, grow into that valuation tomorrow.
Precisely. The strict math says 477, but the bulls argue that 136% delivery growth completely breaks the historical assumptions of those models, which justifies that 36% premium.
Right.
However, the risk you pointed out regarding retail traders is incredibly valid. Retail investors often get caught up in the pure momentum, the dopamine hit of seeing green candles on the chart.
We all love the green candles.
Of course we do. But they ignore the downside risks. If NIO stumbles in the next quarter or deliveries slow down, the narrative of explosive growth vanishes.
And then what happens?
When the narrative vanishes, the growth premium vanishes with it, and the stock will rapidly correct down toward that strict mathematical 477 valuation.
Wow.
That is the exact mechanism of how retail traders get trapped.
And to figure out who's going to win this tug of war, The optimistic retail trader riding the momentum or the skeptical math model pointing to 477, we have to examine the massive real-world roadblocks and catalysts ahead.
Because it doesn't exist in a vacuum.
Exactly. This stock price doesn't exist in a vacuum. Let's talk about the risks, starting with the macro environment. We're seeing new trade barriers and tariffs popping up in Europe and North America.
The major headwinds.
Yeah, in a sector where international expansion is supposedly the key to limitless growth, that's a massive wall suddenly appearing on the track.
It's a structural barrier. The EV market is becoming increasingly fragmented by geopolitical boundaries.
Right.
If NIO is largely locked out of North America and faces punitive tariffs in Europe, their total addressable market shrinks overnight.
Which means they have to rely on China.
They are forced to rely overwhelmingly on the domestic Chinese market. Now, the Chinese EV market is massive, but it is also the most cutthroat, hyper-competitive automotive market on the planet right now.
It's a bloodbath over there.
Total bloodbath. Everyone, from legacy makers to tech giants entering the space, is slashing prices just to steal market share.
Which brings me to the detail in this earnings report that genuinely shocked me.
Let me guess, R&D.
Yes, R&D spending. In Q4, NIO cut their research and development spending by 44%.
It's a huge cut.
Okay, let's unpack this. Slashing R&D by 44% in the hyper-competitive EV space feels like deciding to stop practicing right before the Olympics.
That's a good way to put it.
I mean, sure, it saves money today and helps print a nice profitable quarter to get Wall Street excited, but aren't they sacrificing their long-term survival just to please Wall Street now?
It's a risk.
They are competing with Tesla, with Xiaomi, with companies that are pouring billions into autonomous driving and next-generation battery tech. How do you survive if you stop innovating?
It's a brutal trade-off, but if we connect this to the bigger picture, you can see that agonizing balancing act management is forced to play.
Right.
Go back to our discussion about the balance sheet. They have over 450% debt to equity and current liabilities that exceed their current assets.
So the bills are coming due.
Exactly. That means they have bills due now. They desperately needed to prove to the market that they could achieve profitability to ensure their near-term survival and secure liquidity. The quickest, most effective way to engineer a profitable quarter is to drastically cut your biggest discretionary expense, which is research and development.
So it's basically pure survival mode.
It is the ultimate high-stakes gamble. Management is betting that their current technologies stack their existing autonomous driving software, and their current battery tech is advanced enough to carry them through the next few sales cycles without losing ground to Xiaomi or Tesla.
They're just buying time.
They're buying time, but you are entirely correct about the long-term risk. In tech, if you stand still, you fall behind.
Yeah.
If rivals use this window to widen the technological gap, NIO's 44% R&D cut could be remembered as the fatal moment they traded their future for a single quarterly headline.
That is a terrifying tightrope to walk, especially if you are holding this in your portfolio, which I think sets up our bull and bear cases perfectly.
Let's hear them.
The best case recovery scenario for the bulls relies on a few critical things going exactly right. First, they have to sustain this new, profitable bottom line. It can't just be a one-off accounting trick or a temporary R&D diet.
Right.
Second, they have to capitalize on that massive 136% March delivery growth and prove it wasn't a fluke. And finally, everything hinges on the successful launch of their ES9 flagship SUV.
Yep.
If they nail all three, the growth premium is fully justified.
And the bear case is the exact opposite, driven by the structural mechanisms we've outlined today.
What's the worst-case scenario?
The worst-case continuation lower happens if that crushing 450% debt load finally catches up to them, especially if a broader economic slowdown hits consumer spending.
Right.
If the cutthroat Chinese market forces them to lower prices again, erasing those beautiful 17.5% gross margins we talked about, the narrative breaks.
And if the narrative breaks?
If the narrative breaks, the market will suddenly decide to strictly enforce that $4.77 DCF valuation, meaning the stock has a very long way to fall from $6.87.
Man, and as for the outlook, it's really a tale of two timelines. In the short term, we're talking over the next few weeks, everyone is expecting heavy volatility as the stock tests that $7 resistance level.
It's going to be bumpy.
Yeah, the market is basically holding its breath waiting for the pre-sales data on that new ES9 SUV. But in the medium to long term, all eyes are on management's projection. They are projecting 40 to 50% delivery growth and targeting full-year profitability in 2026.
That projection is incredibly ambitious.
You think it's too high?
I mean, going from a single profitable quarter to full-year profitability while navigating international tariffs, massive legacy debt, and a reduced R&D budget is a monumental task.
It's a lot to juggle.
It is. The short-term price action will largely be noise, driven by that overbought RSI and momentum traders jumping in and out.
Right.
But the long-term reality of this company will be dictated entirely by their ability to execute on those ES9 deliveries and manage their liabilities without diluting shareholders.
So what does this all mean for you, the listener? I mean, we've covered a dizzying amount of data today.
We really have.
We've got record revenues and a historic first profit, but we've also got towering debt and a severely slashed R&D budget. We've got a stock price breaking through long-term moving averages, but the technical speed cameras are flashing overbought warnings. How do we synthesize all of this?
It comes down to this core conflict.
Yeah.
NIO is a company that has finally proven on paper that its business model can scale and make a profit.
Which is huge.
That is a monumental milestone in the EV space that should not be ignored. However, it achieved that milestone while carrying immense debt, stepping into stiff international tariffs, and drastically cutting the innovation budget that built its brand in the first place.
Right.
Right now, it is riding on overbought technicals driven by retail enthusiasm, while institutional investors remain cautious. It is the definition of a high-risk, high-reward pivot.
It really is. A true crossroads moment for the company.
And it leaves us with a critical question to consider, something to look out for not just with NIO, but, with any hyper-growth stock in your portfolio.
What's the question?
When a stock's momentum completely divorces itself from its historical cash flow value, does the market eventually force a correction, or can a company innovate fast enough to make the math catch up to the hype?
That is the multi-billion-dollar question. And remember, you need to keep your eyes wide open, because the EV market takes absolutely no prisoners.
No, not at all.
It will test your convictions every single day. And that is all the time we have for today's deep dive.
Thanks for listening.
Do not forget to like this video, subscribe to the YouTube channel, and it is strictly compulsory that you leave your feedback in the comment section. Let us know if you think NIO is a strong buy or a classic value trap. Keep learning, keep questioning, and we'll see you on the next one.